Ever wondered what types of investors are there? Well, wonder no more. Welcome to the exciting, complex, and sometimes perplexing world of investors. It's a world that may seem daunting at first, but once you start understanding it, you realize that it's just like a grand chessboard, with each player employing different strategies to achieve their goals. There's a broad spectrum of investors out there, each with their own unique approach to the game. Some of them are guided by the fundamental value of assets, while others rely on market trends and charts. Some are sophisticated, using advanced strategies and complex financial instruments, while others are insiders, leveraging their unique access to information. Let's start with the accredited investor. These are individuals or entities that meet certain income or net worth criteria set by the financial regulatory authorities. They have the privilege of participating in investment opportunities that are not available to the general public. Next, we have the qualified investors. These are the individuals who have the financial knowledge and the resources to take on higher risk investments. They can be further divided into two categories: the fundamental investors who base their decisions on the intrinsic value of an investment, and the technical investors who use statistical trends and patterns to make their decisions. Further down the line, we have the sophisticated investors. These are the individuals who have a deep understanding of the market, the risks involved, and the complex financial instruments that they use to their advantage. Then, we have the inside investors. They are individuals who have access to non-public material information about a company and use this information to their advantage in making investment decisions. Lastly, there is the ultimate investor. This is a term we use for those who have mastered the art of investing, who can navigate the highs and lows of the market with ease, and who have a long track record of successful investments. Each of these types of investors plays a unique role in the financial market, contributing to its dynamism and vitality. Stay tuned as we delve into the first type of investor, the accredited investor. First up, we have the accredited investor. Now, you might be wondering, what exactly is an accredited investor? Well, let's dive into it. An accredited investor refers to a person or a business entity that is allowed to deal in securities that may not be registered with financial authorities. They are recognized by the Securities and Exchange Commission or similar bodies around the world for their robust financial knowledge, experience, and the capacity to take on the risks associated with unregistered securities. So, what does it take to become an accredited investor? The qualifications are primarily based on an individual's income, net worth, asset size, governance status, or professional experience. In the United States, for instance, an individual must have a consistent annual income of at least $200,000 for the past 2 years, or a combined income with a spouse of $300,000 for those years. Alternatively, they can qualify with a net worth of more than $1 million, either individually or jointly with a spouse. This net worth cannot include the value of the person's primary residence. For businesses, the criteria are a bit different. A business can qualify as an accredited investor if it has assets in excess of $5 million. Alternatively, a business can also qualify if all of its equity owners are accredited investors. Now, you might be asking, why does being an accredited investor matter? Well, the significance of being an accredited investor lies in the access it provides. Accredited investors have the unique opportunity to invest in private placements, hedge funds, venture capital, and equity crowdfunding. These investment opportunities may offer higher returns than traditional public markets, but they also come with higher risks. Being an accredited investor also opens up the possibility to participate in initial coin offerings or ICOs, which are fundraising mechanisms in the realm of cryptocurrency. This status also allows individuals to invest in startups or small businesses that are looking for capital to grow but aren't yet ready or willing to go public. However, it's important to remember that with great power comes great responsibility. As an accredited investor, you are also expected to have the financial savvy to understand and take on the risks associated with these investments. This is why the Securities and Exchange Commission has set such high financial thresholds. They are designed to ensure that accredited investors have the financial stability to absorb a loss should an investment not pan out as expected. In summary, becoming an accredited investor is like receiving a special key to a select club. This key unlocks opportunities not available to typical investors, allowing them to invest in private companies, real estate projects, hedge funds, and more. But remember, this key should be used wisely. The world of unregistered securities can be a risky one, and it's essential to have a thorough understanding of the risks involved before diving in. It's also worth pointing out that the rules and regulations surrounding accredited investors can vary by country. So, if you're considering becoming an accredited investor, it's crucial to familiarize yourself with the specific requirements in your jurisdiction. So that's the accredited investor for you. Next, we move on to the qualified investor. Now let's turn our attention to the qualified investor. In the vast landscape of financial investment, there's a special breed of investor, known as the qualified investor. This term may sound a tad intimidating, but don't fret. We're here to demystify it for you. So, what exactly is a qualified investor? In essence, a qualified investor is an individual or a business entity that possesses the expertise, experience, and financial resources to engage in more advanced forms of investment activities and bear the potential risk associated. Now, you might wonder, why would someone want to become a qualified investor? The answer is simple. It opens up a world of investment opportunities not accessible to the average investor. These can include private placements, hedge funds, and other forms of alternative investments that can potentially offer higher returns. But becoming a qualified investor is not an open-door policy. There are certain criteria that one must meet. These criteria vary from country to country based on the financial regulations in place, but they generally revolve around a couple of key factors. Firstly, there's the wealth factor. Often, regulatory bodies require individuals to possess a certain net worth or a specific amount of investable assets. This is to ensure that the individual has the financial capacity to absorb potential losses from their investments. Secondly, there's the experience factor. Being a qualified investor is not just about having deep pockets, but also about possessing the knowledge and understanding to make informed investment decisions. This can be demonstrated through the individual's professional experience in the financial sector or their personal investment history. Once these criteria are met, one can be officially recognized as a qualified investor. However, it's crucial to note that being a qualified investor doesn't guarantee success. It simply denotes that the investor has the capacity to navigate the complex world of investments. But let's not forget, with greater power comes greater responsibility. Qualified investors have access to advanced investment opportunities and are expected to conduct diligent research and analysis. They need to be proactive, stay updated with market trends, and be ready to make decisions based on their analyses. The world of a qualified investor is not for the faint-hearted. It requires a certain level of financial stability, investment knowledge, and risk tolerance. But for those who have these abilities, the rewards can be substantial. It's like being granted a backstage pass to the exciting world of high-stakes investing. So if you're someone who's got a knack for financial analysis, enjoys the thrill of taking calculated risks, and possesses the financial muscle to withstand potential losses, then the path of a qualified investor might just be the one for you. But remember, while the potential for high returns is enticing, it's important to stay grounded. As a qualified investor, you're not just playing with numbers, but with hard-earned money. So, always make sure to do your homework, understand the risks involved, and invest wisely. That's a wrap on qualified investors. Let's look at the subcategories of qualified investors. Fundamental and technical investors. Scene script. Meet the fundamental investor. In the vast spectrum of investment strategies, the fundamental investor stands as a beacon of patience and deep analysis. But what exactly does being a fundamental investor entail? Let's delve into it. At its core, fundamental investing involves analyzing a company's intrinsic value. It's the art and science of examining everything about a company, from its financial health to its competitive position in the industry. Fundamental investors believe that the stock market may misprice a company in the short term, but in the long run, the company's true value will be recognized. Therefore, they base their investment decisions not on market trends or hype, but on solid, fundamental business criteria. Now you may wonder, what are these fundamental criteria? Well, they're the key indicators of a company's financial health and performance, which include revenue, earnings, dividends, assets, liabilities, and growth potential, among others. By studying these indicators, a fundamental investor aims to determine whether a company's current market price is overvalued or undervalued. A fundamental investor is akin to a detective. They dive into financial statements, scrutinize annual reports, and pore over earnings releases. They seek to understand the company's business model, its products or services, its market, its competitors, and its growth strategies. They also keep an eye on broader economic indicators and industry trends, as these can significantly impact a company's performance. But why choose to be a fundamental investor? There are several compelling reasons. First, this approach allows for thorough understanding of a company's financial health and future prospects. You're not just betting on a stock because it's trendy or because its price has been rising. You're investing because you believe in the company's fundamentals. Second, fundamental investing can be a more stable and less risky approach, especially for long-term investors. It's not about quick wins, but about building wealth over time. Third, this approach can help identify undervalued stocks, the hidden gems that the market hasn't fully appreciated yet. Buying such stocks at a bargain and holding on to them until their true value is recognized can yield substantial returns. However, fundamental investing is not without its challenges. It requires a significant amount of time and effort to analyze a company in depth. It also requires patience, as it may take time for a company's intrinsic value to be reflected in its stock price. Furthermore, while fundamental analysis can provide a solid understanding of a company, it cannot predict unforeseen events or market fluctuations that can impact a stock's price. In conclusion, the fundamental investor is the meticulous researcher of the investment world. They believe in the power of information and the importance of understanding a company inside and out. They are patient, thorough, and guided by the conviction that in the long run, fundamentals matter more than market sentiment. That's the fundamental investor in a nutshell. Now on to the technical investor. Scene script. Next, we introduce the technical investor. A technical investor, in simple terms, is an individual who makes investment decisions predominantly based on the analysis of market statistics. They are the detectives of the investment world, armed with charts, graphs, and a variety of statistical tools. Their primary focus? Market trends and price patterns. The first thing you might be wondering is, why would someone choose this approach? Well, technical investors believe that the market price of a security at any given moment fully reflects all available information, including the underlying fundamentals. They are less interested in the actual financial condition of a company and more focused on the movements and trends in its stock price. Let's delve a little deeper into the mindset of a technical investor. These investors operate on the premise that history tends to repeat itself. That is, they believe that certain patterns and trends in the stock market will recur over time. They use past market data to predict future price movements, essentially using the past to forecast the future. This might sound like fortune-telling, but it's a bit more scientific than that. Technical investors use a variety of tools and techniques to identify patterns and trends. Some of these tools include moving averages, trend lines, and oscillators. They use these tools to analyze price movements and volume data, looking for repeating patterns that might indicate a potential investment opportunity. Imagine the stock market as a wild, unpredictable ocean. Technical investors are like skilled surfers, reading the waves, looking for patterns, and using their knowledge and experience to ride the wave at just the right moment. They understand that the ocean's behavior is influenced by numerous factors, some predictable and some not. But by studying its patterns and movements, they can make educated guesses about what it might do next. Now, it's important to remember that technical investing isn't for everyone. It requires a keen eye for detail, a solid understanding of market indicators, and a willingness to spend a significant amount of time studying and analyzing market data. Technical investing also carries its own set of risks. It's heavily dependent on timing, and as we all know, timing the market can be tricky. Plus, while history might repeat itself, it doesn't always do so in exactly the same way. The patterns and trends that worked in the past might not always work in the future. Despite these challenges, many investors find the technical approach appealing. It offers a systematic, objective way to analyze the market, free from the emotional biases that can cloud investment decisions. It also provides a clear, visual representation of market trends, which can help investors make more informed decisions. So, who might be drawn to technical investing? It often appeals to those who enjoy analyzing data and identifying patterns. It's also popular among short-term traders who use technical analysis to identify short-term price movements and make quick tactical trades. In the grand scheme of things, technical investing is just one of many approaches to investing, each with its own strengths and weaknesses. Whether it's the right approach for you depends on your investment goals, your risk tolerance, and your personal interests and skills. That's the technical investor for you. Now, let's talk about the sophisticated investor. Let's get a little more complex with the sophisticated investor. In the realm of financial markets, the term sophisticated carries a distinct connotation. A sophisticated investor isn't just someone who has a knack for picking the right stocks or a deep understanding of bond yields. No, the sophisticated investor is a league of its own, a title reserved for those who have not only accumulated substantial wealth and experience in investment, but also have a comprehensive understanding of the complexities, intricacies, and risks involved in financial markets. But what precisely defines a sophisticated investor? The answer to that question varies depending on where you are in the world. For instance, in the United States, according to the Securities and Exchange Commission, a sophisticated investor is an individual or a business entity that meets certain criteria. These criteria can include a specified net worth or certain professional qualifications. In essence, a sophisticated investor is someone who, due to their financial acumen, is exempted from certain securities regulations. They are trusted to understand the risks associated with investing and to make informed decisions. And it's not just about the numbers. A sophisticated investor is someone who has a deep understanding of financial markets and how they function. They understand the impact of geopolitical events on market trends and how macroeconomic indicators influence individual stocks or sectors. They have an innate ability to decipher the complex financial jargon that can often seem like a foreign language to the uninitiated. Now, you might be wondering why someone would choose to become a sophisticated investor. Well, there are several reasons. For starters, being a sophisticated investor opens up a world of investment opportunities that are not available to the average investor. These can include private equity deals, hedge funds, and other alternative investments that can offer higher returns than traditional investment avenues. Moreover, sophisticated investors often have a higher risk tolerance. They are willing to take calculated risks in pursuit of greater returns. This doesn't mean they throw caution to the wind. On the contrary, their decisions are often backed by rigorous research and a deep understanding of market dynamics. However, it's important to note that with these greater opportunities and higher risks come greater responsibilities. Sophisticated investors need to be constantly on top of market trends and shifts, continuously updating their knowledge and honing their skills. It's a significant commitment and requires a certain level of passion for the world of finance. Another key characteristic of a sophisticated investor is their ability to diversify their investment portfolio. They understand the importance of not putting all their eggs in one basket and spread their investments across a wide range of asset classes and geographical locations. This helps them mitigate risk and maximize returns. In conclusion, the sophisticated investor is a unique breed of investor. They have the financial acumen, the experience, the knowledge, and the risk tolerance to navigate the complex world of investing. They have access to a wider range of investment opportunities and have the ability to make informed decisions that can lead to higher returns. Becoming a sophisticated investor is not a destination but a journey. It requires continuous learning, staying abreast of market trends, and constantly adjusting investment strategies based on changing market conditions. It's a path that is not for everyone, but for those with the passion, the dedication, and the financial acumen, it can be a rewarding journey. That's the sophisticated investor. Next up, the inside investor. Now let's delve into the world of the inside investor. The inside investor is a unique character in the financial world. This investor has a special relationship with the company they are investing in, often because they are part of the company's management or board. In some cases, they might even be a significant employee. The inside investor is privy to important information about the company that is not available to the public, which can give them a unique advantage when investing. Let's consider some of the characteristics that define an inside investor. First off, they have a deep understanding of the company they are investing in. They are involved in the day-to-day operations and strategic decisions, so they have a clear picture of the company's financial health and future prospects. They are also aware of any significant events or changes that could impact the company's value, such as a new product launch or a change in leadership. Another characteristic of an inside investor is that they often have a substantial amount of their personal wealth tied up in the company. This can create a strong motivation to see the company succeed, as their financial future is directly linked to the company's performance. However, it also means they have a lot at stake and might be more risk-averse than other investors. Now let's talk about the advantages and disadvantages of being an inside investor. One of the biggest advantages is access to information. Inside investors are privy to the inner workings of the company, which can give them a unique perspective on its potential for growth. They are often the first to know about any significant changes or developments that could impact the company's value. This can give them a head start when making investment decisions. However, this advantage can also be a double-edged sword. Inside investors are subject to strict regulations to prevent insider trading, which is the illegal practice of trading stocks based on non-public information. Violating these regulations can result in severe penalties, including fines and imprisonment. Therefore, inside investors must be extremely careful about how they use the information they have access to. Another advantage of being an inside investor is the potential for high returns. If the company performs well, the inside investor stands to benefit significantly. This is because they often own a substantial amount of the company's stock and might also receive additional compensation based on the company's performance. On the flip side, the inside investor also faces a high level of risk. If the company performs poorly, they stand to lose a significant amount of money. Additionally, their financial future is closely tied to the company's performance, which can create a high level of stress and pressure. Lastly, inside investors can face potential conflicts of interest. Their role in the company might require them to make decisions that are in the best interest of the company, but not necessarily in their best interest as an investor. This can create a tricky balancing act and require careful management to avoid any potential ethical or legal issues. In conclusion, being an inside investor can be both a blessing and a curse. It offers unique opportunities for high returns and access to privileged information, but it also comes with significant risks and potential pitfalls. As with any type of investment strategy, it requires careful consideration and a clear understanding of the potential rewards and risks. That's all about the inside investor. Lastly, let's talk about the ultimate investor. Finally, we introduce the ultimate investor. This intriguing title may have you wondering, what exactly is an ultimate investor? Well, in the world of finance, an ultimate investor is someone who has mastered the art of investing, blending various investing styles and strategies to achieve exceptional results. They are the epitome of financial savvy, a virtuoso in the symphony of wealth creation and growth. An ultimate investor has the wisdom of an accredited investor, the discerning eye of a qualified investor, the analytical mind of a fundamental investor, the predictive abilities of a technical investor, the sophistication of a sophisticated investor, and the inside knowledge of an inside investor. They are a hybrid, fusing these diverse approaches into a comprehensive, adaptable strategy. Now, let's delve into the characteristics that make an ultimate investor stand out from the crowd. Firstly, an ultimate investor is adaptable. In the ever-changing landscape of the financial market, adaptability is key. They can shift their strategies based on market trends, economic indicators, and even global events. They know when to be aggressive and when to be conservative, when to buy, hold, or sell. Secondly, an ultimate investor is knowledgeable. They have a broad and deep understanding of various investment vehicles, from stocks and bonds to commodities and real estate. They are not confined to a single market or industry. Their portfolio is diverse, reducing risk and maximizing potential returns. Thirdly, an ultimate investor is patient. They understand that wealth creation is not a sprint but a marathon. They are not swayed by short-term fluctuations but focus on long-term growth. They know the power of compounding and are willing to wait for their investments to bear fruit. Fourthly, an ultimate investor is disciplined. They have a plan and stick to it, not allowing emotions to cloud their judgment. They are not swayed by market hysteria, either fear or greed. They keep their eyes on their goals and make calculated decisions based on facts and analysis, not speculation or hearsay. Lastly, an ultimate investor is constantly learning. They understand that the world of finance is dynamic, with new trends, products, and strategies emerging all the time. They stay informed, always seeking to expand their knowledge and skills. They invest not only their money but also their time in education, knowing that knowledge is the best investment of all. So why would someone aspire to become an ultimate investor? The answer is simple: financial freedom. Ultimate investors have the ability to generate a consistent income from their investments, providing them with the freedom to live the life they desire. They are not tied to a 9-to-5 job. Their money works for them, not the other way around. They have the freedom to pursue their passions, spend time with their loved ones, and enjoy the finer things in life. Becoming an ultimate investor is not an overnight process. It requires dedication, discipline, and a desire to learn. It's about making informed decisions, taking calculated risks, and staying the course despite the inevitable ups and downs of the market. It's about understanding that investing is not about getting rich quick, but about building wealth over time. That's the ultimate investor for you. Now let's wrap all this up. So there we have it, the many types of investors in the financial world, each with their unique strategies, approaches, and objectives, all navigating the vast landscape of opportunities in their own distinct ways. Let's take a quick trip down memory lane. We started our journey with the accredited investor, who meets specific income and net worth requirements. This investor has access to a world of investment opportunities that are typically off limits to the general public. Then, we moved on to the qualified investor, a step further into the realm of high finance. These individuals have demonstrated a keen understanding of risk and return, allowing them to partake in more complex and potentially rewarding investment vehicles. We delved into the strategies of the fundamental investor, who bases their decisions on the intrinsic value of assets, and the technical investor, who focuses on statistical trends and patterns in the market. Each has a unique lens through which they view potential investments, using their respective methods to identify promising opportunities. We then discussed the sophisticated investor, who boasts a comprehensive understanding of the financial markets and can navigate them with a degree of finesse that sets them apart from their peers. The inside investor, with their access to non-public information, and the ultimate investor, who integrates all these methods into a well-rounded investment strategy, were our final stops. Understanding these various types of investors isn't just a fascinating exploration of the financial world. It's also a vital part of cultivating your own investment strategy. With knowledge of these different approaches, you can better understand your own financial goals, risk tolerance, and investment style. Remember, the type of investor you become depends on your financial goals and risk tolerance. There's no one-size-fits-all answer, and the route you choose to take should be one that aligns with your personal financial journey. Choose wisely and invest smartly. Until next time.